Good afternoon, guys, or good morning, wherever you might be in the world. I know that everyone seems to be quite widespread on the channel and the Discord. For those of you that might not know who I am, my name's Jay, or James, on the Discord. I know that I would have spoken to a lot of you already through the Discord if you're a returning viewer, or maybe this is your first time to the channel as well, which, you know, in fact is even better. So I just wanted to come on, and thank you to Roberts as well for letting me on. If you can't already tell from the previous videos, I'm not the person that uploads the bulk and the majority of the videos. It's also the first time that a face has actually appeared on the channel to my knowledge, so hopefully that can continue. The main reason that I wanted to come on, really, just to show you a few things that I've been doing recently to help out some of the current Discord users and the current YouTube video watchers, to just sort of go through exactly how I trade, why I trade it that way, and to just sort of break down a few of the basics really behind order flow trading. Now, I know order flow may seem like a sort of like a taboo sort of flavor of the month way of trading, if you like. I've really found some really great success with it myself, so I just wanted to go through, give the basics of how I trade and why I trade it that way, and hopefully it might be able to help a few of you guys out as well, because I know that I use a lot of the words, I go through a lot of the strategy on the Patreon only channel with Discord. It's something that I'll touch on a little bit later, just to, in case you do want to get involved with that. But the main thing really is to just show exactly why I sort of do things, how I do them. So just to give you a bit of background about myself, just in case you don't know who I am or I haven't spoken to you on the Discord. My name is James. I've been trading futures now for maybe 2 or 3 years. I actually started trading about 5 or 6 years ago. I started in the futures, sorry, not the futures, the Forex markets, trading the Forex markets with the typical sort of Bollinger Bands and EMAs, SMAs, trying to just find out a strategy. Moved more into the indicators, trying to find a system that worked like an algorithm, if you like, with different trading indicators, and that's actually where me and Roberts bumped into each other and we started working together. I've since drifted away from indicators, just trying to actually trade price action, which I've managed to find some success with. It does take a little bit more to learn it. It's a discretionary strategy at the end of the day, so it can be a little bit more tricky. But again, if you have set rules in place and you sort of know what you're looking for, then it can be quite successful. So just to take you through a few things just with order flow trading. Obviously that's the reason that you're here, and the reason that you're watching the video. There are a few things to know about order flow trading. Now, the main one really is that it doesn't work for all markets. Now, it works perfectly well for the futures markets. We can get the data for that, and that's something I'm going to touch on in just a second. But with Forex, it's not something that it works very well with. Now, the main reason being for that is that Forex is over the counter, or OTC as a lot of people know it as, which means that it's not centralized. So there's not a lot of data for that. You can trade Forex through lots of different brokers, and you'd have to get a lot of different data sources from lots of different brokers to really know where the orders in the market actually are, for it to be accurate. Now, with futures, it's slightly different, with the markets being centralized with different exchanges. So the main two futures markets that I trade, or exchanges should I say, are CME and Eurex. Now, CME would be the American side of the futures markets, with Eurex being the European side. Don't trade too much Eurex nowadays, just due to the times of day with trading. I like to trade in the afternoons through the sort of central time in the US, which is about 1 p.m. for me, and up to maybe 9 p.m. And also there's a different range of markets that you can trade, such as crude oil and gold, which aren't available on Eurex. So the main reason they're so great for order flow trading, you just may pay a fee, monthly fee for the data, which is something, again, I'm going to touch on in just a second, but then that allows you to get the data for your order flow trading. Now, the first thing to really touch on with order flow trading is the depth of market, or the DOM. A lot of people also refer to it as the price ladder. What I'll do is actually pull one up on the chart here, just so I can take you through that. So if I open up a trading DOM here, there's two different colors just to note on this chart here. There's a beige color, and there's also a blue color. Now, this charting platform is also known as Sierra charts. Now, it's slightly different to other charting platforms that I may have used in the past, such as Trading View and things like that. I will just leave a link in the description or in the pinned comments, just with a link to Sierra charts. Not in no way affiliated with them at all. It's just the charting platform that I use. What we can see from here is that the current price is just the middle line here between the two colors. See it at 4157 on the nose, pretty much, or just thereabouts. So obviously on the right here is what we can see that's exactly where the price is. So 4158 around around there, that sort of, you know, what there now. So just to take you through the key sort of points on the DOM. You can see all the resting orders here. So on the left and the right, we can see the where the resting orders lies, or the actual passive liquidity in the book. So we can see if we go down to, say, 4156, the price point here, we can see that there's 52 lots or 52 contracts sat there waiting for a buy. So that's at the bid there. Now, if we go across to the other side, you can see the sell, which is the offer. You say if we go to 4162, you can see that there's 78 contracts being sat there waiting to be taken. Now, how price actually moves in ticks, if you go down to the line, you'll see that there's 16 contracts here and, you know, it moves quite quickly because it's quite there's quite a lot of volume in the market and people are buying at market. But effectively, the way that the markets tick up or down is if these numbers or contracts get taken either at market or just with finalized orders, which is again something that I'm going to mention later on in cumulative delta and what have you. So just with the tick ups and downs here. You can see that if these 10 contracts or 11 contracts get taken, which it did, it will tick up, tick up one tick, which in the E-mini is 0.25, is the smallest tick value that you can get, and then it will also tick down for the 37 contracts get taken. You can also place your orders through the DOM as well, just by clicking into the higher levels or the lower levels to place buy or sell orders. Obviously limit orders at that, but you can also place your at market orders through the DOM as well. It's not something that I do too often. I actually like to go through and just place it through sort of like a trade order terminal, if you like, rather than actually clicking into the DOM. But just two other things to touch on about the DOM, which can seem quite confusing and also a little bit misleading for newer traders. It is something that you can actually see on the DOM, which can sort of throw you off a little bit. So the first one is spoofing to touch on. Now, what spoofing is where a large player in the market, or maybe a market maker, would place a large order above or below the market, showing resting buy or sell orders. And these can just get pulled just as quickly as they were put in. Now, this is actually illegal. You can't legally do this, but the effect really would be that above, say, this green line here, say if it was a key level, you would see that a large player may have 400, 500, 600 contracts to be sold there. And that would give you the impression, obviously, that when price hits it, it's going to eat up all those limit orders and prices are just going to fall. The reason that people actually do this is because then people would step into the market alongside those orders, place their limits, start selling at market, thinking that there's a large player above them that's just going to absorb all the buying pressure, price is going to fall and they're going to make a profit, when actually what happens is the market maker or the person that's placed the spoofed order is waiting for all of the buying pressure to go away, and people are going to be selling there. Then they're also then going to be on the other side of the market, so they're going to have all of their limits below market, and they're going to be taking all of those sellers and turning it into a buy order, building their buy order so that they can then just rocket upwards, taking out all of the stops of those sellers. They've pulled their order for sales out, and it just results in a profit for them. So that's what spoofing is. Now, the next one to talk about as well is iceberg orders. It's not something that I use myself, but I do know a few people that do trade this way. Certain terminals, certain trading platforms allow you to do this, but what an iceberg is just an order type, just like a limit order or a market order, but it would take a large player's order, say if it was 100 contracts on the E-mini, and it would break those down into smaller limit orders, so that you wouldn't actually be able to tell at which price level by looking at the DOM who was trading what, whether it was a large player or 400 smaller players in the market. Another thing to note with the price ladder here is just these resting orders. Now, if I was just go to say 4152, we can see there's 118 resting contracts there. We don't know whether that is 118 people placing an order for one contract, or it could be one person placing an order for 118 contracts. Now, there's no real way to tell that with this data. There's different levels of data which you can purchase from brokers or providers. This here is level 2 data, so we can see the number of contracts at each price level. Tier 3 data or level 3 data would then allow you to see what that actually is made up of, whether it's 50 contracts from one person, 25 from another, etc. Just with your orders, if you were to place them, if you were to say place a limit order here for a bid at 4152 on the dot, then that would mean that this would then tick up to 123 now. Now your order would actually go to the back of the book. So when it hits 4152, if it ever hits 4152, it would take out all of the orders before you, and yours would be the last one to get hit, unless someone obviously obviously placed one after you, and then they'd be behind you. So it actually works on like a queue system of what orders are taken. Now, because the markets are quite volatile, quite, you know, they move quite a lot with a lot of volume, it's likely that if you're placing one contract, you might get filled, two contracts, you might get filled. But for larger institutions or HFTs, or, you know, people that are trading large contracts and large sizes, this is why they use limit orders to just prevent slippage. Now, what slippage is if you were to say place an order at 4152, you know, due to certain, you know, circumstances, it slipped. You may not actually get filled at that price. You may get filled at one price higher or lower. One thing that I actually like a lot more than just the order book and seeing where the resting orders sit, whilst that is useful information in certain circumstances if the orders are genuine, is actually the delta and using a footprint chart. So what I've actually got on my screen here and what you're seeing is a footprint chart on Sierra charts, and what this actually is finalized orders at the bid and the ask price. So obviously more important information is people that have actually placed active and finalized orders rather than just where they can sit and where they can be pulled. So just to take you through exactly what a footprint chart looks like here, you've got two sides of a bar. Now, what we were looking at before, on the left hand side of the DOM is the bids, the buys, and on the right hand side is the offer or the selling side of things. Now, on a footprint chart, it's actually slightly different. Those two are flipped. So on the left hand side, you've actually got the sales, and on the right hand side, you've got the bids. So just to zoom in here and just give you a bit more of an overview, if I can just say pull up a bar, if I take this top bar here, what we'll see is the delta, the volume, and the delta day. So I'm just going to take you through those now. So we can actually see at the top of this bar here, and we can see what price that is on the right hand side there. So 417325. We actually have 28 people that have hit the hit the bid or have obviously had their limit orders filled. And then on the left hand side, say at 4171, we can see that there's 302 orders there that have been sold. Now, the difference between all of these numbers here, if you can see at the top, I know it's slightly small, but it says 8509. Now, 8509 represents a total volume that was traded within this bar. Now, these are 30-minute candles, so within that 30 minutes, 8,509 contracts were traded. That doesn't matter whether they were a bid or an ask, buy or sell. It doesn't make any difference. That's just the total number of contracts that were traded. Now, if you take a look down just below there, you can see that the delta of this candle is 55. Now, what delta is just the difference between the bids and the offers. So 55 is nearly a neutral candle, so there was nearly the exact same number of offers as there was bids, but you can see that there was 55 more contracts bid than there was sold. So to take you through a different example here, if we go over this candle, which is a negative 2486 candle. So there was 2,486 more sales, more contracts sold in this bar than there was offers. Than there was bids, sorry, and we can actually see where all of these lie. So the reason that this is red, I have settings on Sierra chart. Again, I can take you through them if you know there's any Sierra chart traders out there. But this is just a 4. It means that it's 4 or 5 times higher than the average delta on the day. So you can see, you know, these numbers say 681, 407, 451. They're not red because they're not too significant. If they're either blue or red, they're more of a significant bar. So you can actually see down at 41950 there was 622 contracts sold here, 686 down at 4158, and you can sort of see how the bars are made up. Now this is the sort of perks of the order flow trading and using footprints. Is not only do you see the Japanese candlesticks and the bars that you're trading, you can also see how many people were actually placing bids and offers at certain levels within the bars, and you can make your trading decisions based off of that. Just to give you a slight example on exactly why that information is important and the sort of things that we look for, I'll just take you through on NYMEX, the exchange NYMEX, through crude oil, just a couple of candles so you can see exactly what's going on. So just to take a look at a candle that appeared this week, it was something that I also posted about in the Discord, just to have a couple of ideas based off of the footprint. If we take a look at between sort of 5 and 6 or 6 and 7 p.m. on the 2nd of August, just gone, you can see this sort of huge move up with a lot of volume in these green candles here. It also then pin bars and then falls away. So it's quite easy to see, obviously, the sort of pattern if you're a technical trader, but also if I go into the footprint, you can see a lot more of the information here. So As you can see, we're between sort of 5:30 and 7 on the 2nd of August, just down at the bottom there. And what you'll actually find is a bar like this. So just at the top, as we say, there was a lot of positive delta in this bar. So you can see that by the blue 772 at the bottom, which means that there were 772 more bids than there were asks. So it's a very positive bar for delta, meaning that there's a lot of buyers behind it. And you can see these buyers right at the top here as well. So to give you an idea on what the candles look like, this blue part here down at the bottom is the actual body of the candle, as well as the wick. So if this is the body, everything above this point here would just be the wick. Now, if you see in the wick of a candlestick that there has been 2 people trading, 3, 10, 19, these are all buyers right at the top of the wick of a candle. Now you can see all the way down on the right hand side all of these contracts where people have purchased and they're wanting the obviously price to go higher so they can make a profit. Yet the bar actually closes with a body that's a lot shorter than the actual wick itself, and then price obviously falls away. Now, what you can actually use this for, if you see something like this, is in this long wick, you see all of these buyers. They obviously have stops placed somewhere in the market. Now, obviously, we can't see where everyone's stops are, but if price was to fall away like it did with a negative delta of 450 here, these stops are going to get hit. Those people are then going to, either swap their bias, or they're just going to have their stops hit, be taken out of the market. That then adds on to the selling pressure, and that's going to make the markets fall even more. So you can use things like that to your advantage to say, well, there's a lot of buyers in the wick. The price, bars hasn't closed near the top. It's a pin bar with all the trading in the wick that you can look to take a trade based off of that, knowing that if price falls down lower, people are going to have their stops hit. It's going to add to selling pressure, and then if you can get short at a good time, obviously you can take some points out of the market there. One of the last sort of things I want to take everyone through just in the basics of this order flow trading video. Again, I'm going to go through and add a few more parts into this as well with maybe some more advanced features, some more advanced thoughts, as well as how to actually frame a trade as well. It is just to go through the CVD, or the cumulative volume delta. Now that is something based off of what we've just been through, the delta of each candle, which is the finalized orders, and the difference between the asks and the bids. You can actually see it down at the bottom here, and it's something that I use on my actual main chart, and it is an indicator. This is obviously the one on Sierra chart. You can absolutely use it on TradingView as well. It gives you a good insight to what's actually going on. Now, this is just, again, the difference between the finalized orders, and it really does give you a picture of how to trade. Now, what we actually use this for is divergences, so you can see a divergence in the chart, and I'm just going to be able to get you an example here now. The 2 different examples I want to show you is absorption, and the other one is exhaustion. Now, just to show you, the first one here is exhaustion. It's quite a recent one, actually. It's just from a few days ago or yesterday over on crude oil. Hopefully this pen here works. What you can actually see is this high here, followed by this high here. So they're pretty much on a level. Just to see how many ticks ahead one is, let me just quickly pull up the marker here. So you see it's probably a tick or maybe 2 ticks higher. So you can see if I was to draw a line, it's pretty even, when in fact the cumulative volume delta or CVD is actually going down. So what this will actually show you is exhaustion, as price is barely moving higher, if not setting double tops. The actual number of finalized orders between these two is getting lower and lower, which would then show the exhaustion in the market. Now, just to quickly show you a different one, which is over, again, quite a recent one on the E-mini. This one isn't so obvious. It's slightly debatable whether I'd even count this, but it's just to give you the idea. You can see these tops in the CVD, and they're getting lower and lower and lower. This one seems like a little bit more even, but you get this huge move up there. Now that is a lot of buying pressure, when if you actually take a look at the chart to see where price is moving, there's a key level here, which is the green line, and it's barely breaking above, and then it's settling into this range that I've just drawn around there. The price action doesn't quite match the number of finalized orders and the volume that's been pumped into the market, which would then show me maybe slight absorption of the buy orders, and maybe there's a lot of sell limit orders above that sort of mark there, where the orders are just getting eaten and prices just getting absorbed, and it's just creating dojis, as you can always see on the 4-hour chart here as well. This is currently where we are. Now the market's only been open for about an hour, so there's a lot of time for it to move, but also it would give me the idea maybe it might fall lower if there's enough absorption of those buyers. Something that I didn't mention slightly earlier on was just in the case of these lines on the chart here on the CVD indicator. So we've got green and red lines. Now these are single bar divergences. So what that would effectively mean is if we have a red line here, say, and this bar above it, that is a green bar. If we actually follow that up, we'll see that on the actual chart on price, it's actually a red bar. So for every time that we see this, it would just mean that the CVD is showing that there's a lot of buyers behind this bar, but the bar actually closed down and became a bearish bar. Now, what we can actually use that for is if, say, price was to be falling down, down lower, say here, when we get to the bottom, this maybe isn't a great example, but there is some single bar divergence here. If it is falling downwards and the bars are red, yet there's a lot of buyers at the bottom of these bars, which it looks like there was because there's these green bars here. It might show us that it's starting to exhaust itself. The buyers are stepping in as the red bars seem to turn more into dojis. So it could just be a little bit of a sign that we could be looking to go long rather than shorting. It could also be a nice little exit indicator for yourself, just to say, well, we're not going to be falling as much as we thought we were. The buyers are now stepping in, as we can see the single bar divergence, and it could be a case where you just take your order out at full rather than just letting it ride. So not something that you do all the time, and hopefully that makes sense. But it's just important to know that whilst all these indicators are on the chart, you just have to use our discretion. Every single trade's different, and certain setups and certain rules need to be followed before any trades are taken. Now, just to show you this actual concept in action, I just wanted to take you through a gold trade that I took recently. It was actually this week, a few days ago on the 1st of August, so it would have been Monday. I just want to show you this key level here. I had this marked out and posted it into the Patreon channel. This green level here, also following on from this orange line. And again, there's lots of key levels. There's lots going on in this chart. Again, too much to really go through in one video, so I can break that down a bit further. But there was this blue candle here. Now, blue in my charts, just with a couple of the indicators that I've got, indicates high volume. It was a breakthrough here and it closed above, indicating short-term acceptance on the other side of the green line. So just to take you onto the footprint charts, we can see that a little bit better. On the 1st of August, it was at 10 o'clock, so it would have been this bar, this bigger bar here. We can see that the actual body of the candle is very large. It takes up all of the orders pretty much here, and you can also see on the right-hand side of the footprint all of these buy orders, at the top of the bar. So what that indicates to me personally is that there's a lot of people that are willing to still buy contracts either at market, etc., at the top of the bar, showing that there's still going to be that drive to get the prices to come a little bit higher. Now, because it did break out of a level, I was expecting to come back and a retest a little bit lower, which is where I placed my limit order as well. To give you a sneak peek of the actual Patreon channel and exactly what we do in there, this was the setup and the picture that I posted. Now, this was on August 2nd, so this was actually the day after the breakout candle. Now, I do trade the 4-hour and the 1-hour charts, use the 4-hour for order flow as well as sort of confirmations and actual executions on the 1-hour. You can see that the breakout bar was this bigger sort of, blue bar there. I do also use Trading View as well for some of my charting, so it was just that one right there. Now, the order that I actually placed was in at 178.2. That was when where I placed my limit order. It came back down. It took it. It did take me into a little bit of drawdown, but nothing too scary. Just about halfway down through my stop loss, and then it sort of took off from there. Now, this was halfway through the day. It hadn't really moved too much. I got up to maybe 2 or 3R, I believe the top of this that swing high there was, but didn't take my profit. Now, I didn't pull out my order, and then a few, if I just get rid of the white line, I do apologize for that, just a little bit later on through the day, it did rocket all the way up and take target out there as well. Now, there's a few different reasons why I took the trade, why my target was placed there, why my stop loss was placed there. Again, it's not really things that I can really do in one video, but this actually turned out to be a 4R trade for me today, or 3.9R I should say, in the Discord that you can see there. But again, just to give you an overview, we do post daily sort of trade analysis, what we're trading. By no means is it any financial advice. We're not financial advisors by any means, but we just do show what we actually trade, why we're trading it. If you'd like to follow along, take some learners from it, take some lessons, then absolutely feel free to do so. But there also will be a link to the Patreon channel down below. But hopefully the information that I've given you today has helped. Again, it's a very, very basic introduction to order flow trading. What means what and how it works. What you'll tend to find is a lot of the courses, a lot of different sort of signal providers, things like ICT and smart money concepts is quite a big one that a lot of people seem to use and sort of gravitate towards. Why they work, sometimes it doesn't quite go into enough detail about why things work and just shows you what actually works. So this really gives you a little bit more information into the sort of strategies of those sort of methods, if you like. So if you would like to see more going forward, if you'd like to see more of myself, if you'd like to see a bit more on the strategy and exactly how things work, I can go into value areas, auction market theory, all that sort of stuff, and you can tie it together in one to make your own discretionary trading strategy. So if you'd like to see more of that, please just make sure to drop us a comment, let me know, come into the Discord, say hello to me, add me on there, and really just sort of get involved with the community. We've got some great things going on, and it's only going to get better from there.